Hello and welcome back to The Note. Fund managers have a problem. After years of QE, we all know that bonds look too expensive and that equities look even more expensive. So what exactly are they going to invest in, and how do you play the inevitable eventual exit from the QE environment? My guest today is a man who has to spend most of his life wrestling with these issues. He's the Global Head of Investment for Towers Watson, Chris Ford. Chris, thanks very much for joining me today. Let's start by taking a look at the 10-year Treasury yields, which has surprised many people with a noticeable reduction in yields once more this year. So the Treasury bull market is not dead just yet, in deference to Monty Python. What's the story behind that shift in yields this year?
Well, actually, we've seen a long-term decline in yields, which obviously is about reducing inflation environment, and then more recently QE. Now, actually, we don't really see there's been very much structural change. At the start of the year, we saw some improvement in optimism, and you know, that resulted in a bit of a bounce in yields. But fundamentally, we're in the same environment where we've got low bond yields as a result of low policy rates and QE, supporting equity markets, trying to keep us going on this path to restructuring and deleveraging. So to our mind, no real change. Actually, bond market's pretty fairly priced.
Okay, now let's take a look at how we're going about projecting where we're heading. And your own calculations here suggest that we do have rather a significant hike ahead of us. How do you define these rates, and how well do you think fund managers are positioned to deal with them?
Sure. Well, John, this chart is actually the forward rates implied by bond markets, and we've adjusted for a term premium. And I think what's interesting here is what's already priced into bond markets is an increase in cash rates from around 0 today to around 3.5% over the next 10 years or so. I think that's pretty plausible as a path for future rates. And actually, if you average that, those cash rates, you get 2.25%, which compares to a Treasury yield of 2.6 when we did these numbers. So actually, bond markets are giving you a fair return for the expected path of future rates.
Which is startling, because people doesn't feel that way. Let's take a look at expectations for inflation, which obviously critically affect the value you get from bonds. At the moment, we are avoiding hyperinflation and we're avoiding deflation if the market is right.
Well, I think this is a very interesting chart, because over the longer term, I think most commentators would expect average inflation rates to be rather north of 2%. Many central banks targeting inflation rates north of 2%, and if the upside or the error is on the upside, you'd expect it to be above 2. Yet we're actually seeing prices for inflation in the low 2s. And actually, to our mind, that implies that there is a concern about deflation. And to us, the big issue is all about deflation. Not the event of deflation, but what caused the deflation. And that's the big risk.
Okay, now let's take a look, therefore, at what you can actually invest in. This is fascinating. You know, Sharpe ratio is a basic measure of adjusting for risk. Your suggestions are that basically there's a family of debt investments that make more sense than either equities or conventional bonds, and also a group of very alternative measures of perhaps all ultimately you could call smart beta that make much more sense. How did you arrive at these conclusions? How do fund managers put these suggestions into practice?
Well, the principle here is I think reasonably straightforward, that there are equity and bond premia that everybody's familiar with, and actually balancing equities and bonds makes a lot of sense, particularly in a deflationary environment. But you can add into that exposure to, I'd say, two main categories. We'd call them all smart betas. Smart beta to us is not an equity strategy. It's getting a smart exposure to a different form of return premium.
Such as value or momentum or...
Value or momentum, or actually real estate or infrastructure. They are betas, and you just want to get a smart, sensible, transparent, low-cost way of getting exposure to them. So actually on this chart, I've got a group of what I might call economic premia, high yield all the way through to timber, and then another group of the kind of more factor-based exposures like fundamental weight or carry or volatility, which those things are a bit newer. They've been well used, well documented, both by academics and practitioners over many, many years. And in fact, these are the returns over the last 10 years, the risk-adjusted returns. So they're very well documented, they're available, and an increasing number of asset managers are creating funds that deliver these premia.
Okay, Chris, thank you very much indeed. That was somewhat of a whistle-stop tour of the options for fund managers, but I think some things are very clear. Yes, rates are going to rise. We do have to prepare for them, and perhaps one of the best ways to do that is by looking at some very much less conventional forms of investment. Fund managers are thankfully already doing that.